this bipolar market, if you remove 3 stocks, you're looking at perhaps a Nifty level of 10,400. The mid cap is already looking like, we are at 10,200, 10,300.
Right.
Your thoughts on what's happening here?
So despite the fact that the headline index has done nothing, we are actually significantly underperforming the emerging markets. Emerging markets have had a great start for the year. They're already up 10% in dollar terms, and we are broadly flat. And when I look at some of my friends' portfolios in the FI category, most of them are down 5-6% for the year. So I don't think it started well for most FIs as far as the portfolio is concerned. And as you said, the headline has hardly done anything, but portfolio is actually down. I agree with you that the bipolar market, where only few stocks are doing well, isn't a great texture of the market. You just don't feel good about what's happening in the market.
Okay. But so still not giving up either. The index is still sticking on. Is it that you will expect a big fall when the 3 or 4 stocks, the Reliances and the Infosys and the HDFC banks are not able to hold the entire market? How should we prepare for a market that seems to be running on fewer and fewer stocks?
Or it could be the other way around, that there is there's a wall of worry about a lot of the other stocks, and they could just participate. And even if these stocks have a time correction, I would say that is the best case for the market, where you see time correction for some of these few stocks which have rallied, and many of the others sort of participate over a period of time as some of the clouds and the worries abate. So that would be the best case for me. But it's very tough to predict because we have so many uncertain events from here to maybe in the next 4 months that market's worried.
Sridhar, how are you looking at the worries in the consumption space? I mean, until now, Maruti was quite clearly always one of the leading stocks. We've got for the last 2-3 months now, it doesn't look like a one-off anymore. When for 3-4 months in a row, you have lower and lower sales coming in from the 4-wheelers and the 2-wheelers. What's going wrong in that space?
So I think
do you see
we have to put things in context that they've also had great performance over the last 4-5, at least 3 years. They've had brilliant performance. Keep in mind that the structure of the market also changed, where you had the aggregators also coming in. And if you actually dissect the number, the aggregators actually contributed a lot to the incremental growth of many of these companies. Some of them are facing headwinds because the aggregators, their business model is coming under question. So I think there is a small change here. Even for 2-wheelers, it's a discretionary consumption. We've had some changes in regulation. So I think it has to be seen with a context that this possibly is a cyclical slowdown in my view, and they would catch up given the fact that India's penetration in many of these aren't so great. So I wouldn't be so worried. But the fact that some of these stocks have corrected suggests that your risk reward is slightly better today than it was, say, 3-4 months back.
And you did mention that one space that you like is the 2-wheeler space after the fall.
Right.
Have you guys at Enam done any research on what the demand situation on the ground is? Because when we talk to a lot of dealers, they say that things could get worse before they get better.
So that's possible, given the fact that we take slightly longer term view on most stocks that we look at. So it's possible that there could be some more pain because of the change in regulation, as I mentioned, the insurance cost and many of the other issues that have come through on this. But we do believe that over a period of time, they will come back to their mid-teens growth, maybe in a year's time or so. And we're currently also facing margin issues because of the cost pressure that they have seen, and some of that also has come off. So on the whole, we think the risk reward is better. It's not like they are screaming buys, but at least they are far better than where they were, where we were giving them consumer valuations, say about 6 months back. Now they are more like discretionary valuations. So to that extent, it looks better.
Okay. Last year, IT index was up some 30%. TCS was up 45%. At the start of this year, it looked like the mean reversion will play out. It's only gone up, the stark outperformance of IT.
Yeah, so I think this is again coming back to the same that we discussed before, that currently people are just hiding and you're looking for safer havens.
Is it just that, or is the market sensing something big in terms of what's happening in the US and the opportunity for IT companies?
So if I look at, so there's a study on this, if you look at the top 20 IT companies in the world, 11 are from US and 9 are from China. And if you had done this 10 years back, there would have been only 1 or 2 companies from China. My point is that Indian IT companies who were there in the top 10 or top 20, say 10 years back, are not even there now. So they've missed the bus. So what we are talking of is incremental growth, quarter on quarter, some 8% growth. There's no IP created. And this business model will not last for too long. So I'm not looking for hiding places because I don't have that mandate. I don't have a benchmark, so I'm looking for absolute returns. They really don't attract me that much. But if you ask me at the valuations that they are, given that these are cash flow rich companies, yeah, so they may not fall much. So I still believe that this is a place that people are using to hide, because 8%, 9% growth really doesn't excite me.
Okay. What's hurting in the domestic market? I would assume it is the debt market's problems, and every other month we are getting one more company which is over leveraged,
right,
and admitting it in public in one way or the other. Is that the big problem, that it's too much leverage, and the NBFC problem is not over?
So I agree with you. I don't think the NBFC HFC problem is over. At least I've been highlighting this for a long time. I'm very worried with HFCs in general, because my belief is that NHB is a very poor regulator, and they haven't done a good job of regulating HFCs. Look at the structure of HFCs in general. Only about 60% is mortgage. Rest is all builder loan and LAP. And we don't see too much of NPAs coming from this basket at all. And when I look at banks, at least 20% of their builder loans are stressed in some form or the other. And that isn't the case for HFC. How is it possible? So it comes back to the fact that HFC regulations are so easy. You can restructure the loans and not inform the minority shareholders. I've been pushing this for a while, that there needs to be an AQR for HFCs and NBFCs. I'm happy that people like Arvind Subramaniam have also echoed similar sentiments. And I think we should not allow this, this sort of crisis to go waste. Crisis normally is the time when you get sort of
new rules.
Yeah, exactly. And look at the banks. I mean, we have increased disclosure norms, and that has only done good for the sector. So I think the same needs to be done for HFCs and NBFCs, and HFCs in particular, because they come under NHB. But let's see if that happens.
I know there are some people who have been asking for an AQR for NBFCs and HFCs above a particular size.
I think that
where
should
too
take
much
care.
money is involved.
Yeah, that should take care, because one, the regulations are very slack. My point is that if they restructure any asset, it should be disclosed. I mean, that's as simple as that. Then it is left to the investors to decide what valuations to give. Today, we don't even know what they're restructuring, because they don't need to disclose. So as far as the companies are concerned, they're perfectly fine. They're doing what is in their regulation. So there is some information asymmetry as far as investor and the company is concerned, and we know there is crisis in the real estate sector, but we don't see it in the HFCs, so it just doesn't add up.
I also wanted your thoughts on Telecom, because as we speak, Bharti is the biggest loser right now, down almost about 4% odd. Bharti Infratel is also down on the back of the Moody's downgrade that came in. This space is completely falling apart. I mean, one large player and the rest are all sort of falling by the wayside. Is this a space to avoid entirely from an investor standpoint?
Yeah, so generally my view has been that if there is a significant pricing war, you're better off being a consumer than a minority shareholder. I think I'll keep that philosophy intact and continue enjoying as a consumer.
Okay. What about the corporate banks? I mean, we did speak that this is one space that you like, but you expect further re-rating in names like Axis, etc., post numbers?
So we've been bullish on this for over a year now, and have to admit that it's become a crowded space. When we started, we were sort of the loners in this space. And one of the theses was also the way IBC would play out. Have to admit that IBC hasn't played out the way we thought. But maybe a new regulation, it always takes time before these things stabilize. So we are still bullish on this sector. Keep in mind that credit costs are still in the range of 2.5–3%, even for some of the private sector banks. This has to normalize, and it comes closer to, say, 70 to 100 basis points over a period of time, maybe a year or 18 months. These numbers will start looking very different. The ROEs will start looking much better than what they are today. So I think there is still room for re-rating, and keep in mind that a lot of the space has been ceded by NBFCs. They don't have capital. So it's much easier for these private sector banks with new managements to start growing. So it still looks exciting. We're still long some of these stocks.
What else brings this optimism to your eyes? corporate banks, yes. But which is the other space? Which are other spaces that look good to you?
So many of the other spaces are more bottom up. I can't look at many of the sectors and say that they are great. Given that we are entering an election year, consumer spending normally goes up. Not staples necessary, but discretionary. So we do like some of the media stocks which also come under discretionary. Some of the valuations have become extremely attractive right now. And in general, discretionary spending would go up as we enter election year. So I would say some of the stocks in the discretionary space is looking promising right now.
What about realty, Sridhar? I mean, they got a bit of sops in the budget. So hopefully some inventory will clear out as people are don't have to pay too much taxes for second homes. Any motor at all to buy them, or do you think they're troughed out?
Yeah, I'm not a big fan of real estate. The balance sheets aren't so great. These are not the type of
neither the asset class nor the companies?
No, I think the lesser sectors I have to track, the better, right?
Okay.
So it doesn't fall into my radar.
Okay, just one final question from my end then. What's the biggest risk to this market now? If there is a correction coming through the course of the year, what do you think the primary reason for that could be?
I think it will be the financial sector, which is the NBFC, HFC related. We are seeing so many murmurs. I would add the mutual funds also into that. I think many of my friends are in the mutual fund industry, but I don't think they have done very well when it comes to the credit, especially in the debt and the liquid funds. And when I look at the portfolios, I'm quite surprised at what they have lent. So this entire basket, because of promoter lending to HFCs, NBFCs so aggressively, can lead to some sort of a crisis. Keep in mind, they are no longer small. Now you're talking of 15-18 lakhs crores of mutual fund assets. And look at the capital that many of these mutual funds have. They don't need capital, so that's the way the business is structured. But they are lending very aggressively.
So what is your skin in the game?
Yeah, they have no skin. So the loss is to the investor. And I think investors are only now digesting that many of these issues can hurt them. So I think it is time that mutual funds also behave responsibly when it comes to credit standards, especially for debt and liquid funds. I don't think they followed the best practices. That's my personal view.
I wrote some of that in a piece in Mint today, but I think we should thresh it out with a person like you who has seen that side of the fence
Yes,
not too long back.